Welcome to the Street Sessions and our post-budget special. Today we're going to look at the impact of the budget 2020 on individuals, businesses and the economy as a whole. And in particular we're going to be looking at the impact of the budget on personal finance and investment. And I'm delighted to welcome our first guest, Sam Tindale, who's a financial planner with Tower House Wealth Management. Sam, welcome. As we talked earlier, there probably wasn't a great deal in the budget about personal finances for 2020, but there were a number of announcements, and I thought we would explore today the impact of the budget on pensions, the investment market reactions to COVID-19, and also the news that ran before the budget, the announcement that the Bank of England cut interest rates to an all-time low at 0.25%. So, if we may, can we initially start to look at pensions? There were some announcements, and I wondered if you could outline what those announcements were and who they might affect.
Yeah, of course. I think it's probably useful to break it down into two parts and just start with what's not changed and then what has changed. It's been a slightly more exciting budget than in the previous couple of years, which have been a bit lacklustre for financial services. So some of the fundamentals that haven't changed, and there was some huge speculation in the run-up to the budget this year, probably more so than ever, about the loss of things like higher rate tax relief, which I'm pleased to say hasn't changed. So tax relief on pensions has all remained the same. And then fundamentally, corporation tax and its interaction with pensions has remained the same as well. So pension contributions remain, for the most part, a deductible business expense, which again were areas that were potentially going to be challenged in this budget. Lifetime allowance, that's the maximum you're allowed to hold into a pension, has again increased with inflation. So it's still just a little over £1 million at the moment. But again, any increase in that area is useful because the lifetime allowance is the lowest point it's been for a long time. The key change, and one that I'm really pleased with, because from a planning perspective since 2016, this has been really hard work to deal with, was to what we call the tapered or adjusted annual allowance. It's an area that I think a lot of people missed initially when it was brought in 2016, and fundamentally the idea behind it was to start to reduce what the higher paid were allowed to pay into a pension. When it actually came into effect, the unintended consequences, and it's made a lot of news since, were GPs, teachers, anyone sort of working in public sector with final salary pension schemes, which has led to this huge quantity of issues with GPs retiring early, dropping hours, not doing waiting list work because effectively they were negatively impacted by earning too much. So what the government have changed now is that effectively, for those earning less than £200,000 a year, you don't need to give any consideration to the tapered annual allowance. So it's only those who they deem to be in the sort of really high net worth category that need to concern themselves with this. And that's a big increase because previously it was affecting anyone who was earning more than £110,000 a year. So they've actually given us a £90,000 increase. And the idea being that should take a lot of the people that have been caught inadvertently out of the equation. It's also good for effectively anyone earning in the £110,000 to £200,000 bracket. So it's a welcome change because I think particularly the medical profession were really struggling on how to deal with that. In terms of other changes with relation to pensions, I think that probably effectively sums up the main amounts for now.
I suppose the other perhaps good news was he didn't seek to reduce the annual allowance that you may put into a pension. Currently, I think it stands at £40,000, and a lot of people would see that if it was reduced, would restrict their ability to invest in a pension or to provide for later life care and planning, etc. But I gather a lot of people don't always take advantage of the annual allowance.
Yeah, I think you raise a very valid point. That was the other concern coming into this budget, that there'd be further changes to the annual allowance. So the annual allowance, as it stands at the moment, is £40,000 a year, and it was only reduced for those earning more than 110,000, which has now changed to those earning more than 200,000. But yeah, there's quite a lot of people out there who don't fully take advantage of that allowance being available. And in the recent years, I think if we go back to probably 2015, there's been so many changes that have had a really positive impact on pensions that people haven't kept up with. One fundamental point being that pensions and pension wealth is outside of your estate for inheritance tax, which is a point that people seem surprised by when you discuss with this idea. I always say the idea of my friend down the pub who tells me that my pension's going to go to the government when I die, and it's just simply not the case anymore. So the annual allowance has remained at £40,000, and obviously for those in a position to utilise that, it remains a fantastic planning opportunity.
And I suppose it does link to the fact that often people don't see pensions as a good investment or provision. They often invest in property, but also against the background that in the last week or so we've seen a significant drop in the stock price of the value of the stock markets globally, the impact of the coronavirus. That must raise concerns for people with investments linked to the stock market. What should they be doing? Do they need to panic? I gather it's nearly back to 2008 at the time of the financial crash. What would your advice and guidance be in the current climate?
Quite right. I think we are just about approaching on 2008 style losses. Looking at the FTSE 100, that's down about 22% year to date, which is obviously some pretty significant numbers. That's not necessarily reflective of investment losses for those who hold pension funds, ISA funds, because generally speaking, if they're using a fund that's managed by a fund manager, they should be managed on a more diverse basis and not just tracking what one index is doing. But all global markets are falling. What's surprised me is probably been the reaction that we've seen from our own business, that we've had probably more people picking up the phone and calling up asking about further investment on the basis that the sort of concept of time in the market, and arguably you look back by the comparison to the beginning of this year and the market is 20% cheaper than it was. So there is certainly an element of a potential buying opportunity. However, I always try and remain firmly long-term in my views. I always, when speaking with my own clients, talk to them about trying to stay away from timing. Just stick to the fact that when you have an investment, you'll have started your investment for a reason, you'll have selected an appropriate risk profile for a reason, and you'll have had a timescale in mind for a reason. And it's important in these times that you just focus on that long-term nature of the investment. I'd like to think that there's no one out there who's invested for anything less than 5 years, because realistically to enter the markets you need to be giving yourself at least 5 years. And the reality of a lot of the money that we manage is pension money, which by nature has a very, very long term. The biggest risk to investors at the minute truly is themselves, and that is that if we go back to the absolute basics of investing, you don't sell at a loss. We often use the term paper loss, which is in effect at the moment, on paper, yes, your investments may be down, but until you take the choice to take those out or move to a safe haven like cash, make a big strategic decision, you've not physically lost any money. So my advice to anyone is think about the advice you took when you first set up that investment. Go back to the reports you would have received, go back to your plan, and question yourself if you're thinking of making a short-term decision now based on that. The wider marketplace, in terms of sort of specific areas that are affected, the FTSE seems to be one of the hardest hit areas. Looking at some of the Asian and Japanese markets and global markets, although falling, they still seem to be holding up comparatively well by consideration to the UK. The US markets are also pretty significantly down year to date, and I suspect Donald Trump's decision this morning to restrict travel in and out of America to Europe is probably going to have an impact on that as well. So the probably question that we get a lot at the moment is, where's the bottom? And short of having a crystal ball, it's impossible to give that answer. But what we do know at the moment is that there's a 20% discount on what there was 1 month ago. So sort of closing statement on that one. Remain long term in your views. Try stay away from short decisions. And ultimately, if you do take advice, if you do have an investment manager, this is the time to be having a conversation with them and getting their views.
Thank you. If we may conclude on the interest rate cut very briefly. Obviously, it was quite a bold move just before the budget to reduce the interest rate from 0.75% to 0.25%, which is actually the lowest in history. Briefly, do you think it'll have an impact on, obviously it's designed to support the economy and businesses that and consumers who may find their income squeezed, but equally, do you think it'll have an impact on the investment markets and investment decisions?
So I think what the Bank of England have decided to do, as you say, broadly speaking, is they've lowered interest rates, which is substantial. There wasn't a lot of wiggle room left with interest rates, so the decision they've taken to withdraw it by 0.5% is substantial. The intended consequences are that if interest rates are lower, it discourages people from holding cash, and it's trying to encourage investments. I think people were already getting to a point where they've realised the potential for getting a long-term return out of cash was dwindling anyway. I think this probably further reinforces that, although the intention for this is only meant to be shorter term. Interestingly enough, it sort of, if you were to take the Chancellor's views on interest rates, he's obviously borrowed heavily to fund his budget, so their views are clearly that this is going to remain lower for longer. There's no guarantee when it comes to that. I think the main winners in this situation are hopefully going to be those who've got variable mortgages or people looking to step onto the property ladder. As borrowing is cheap, it normally takes a few weeks to reflect in things like mortgage rates when you actually see an interest rate reduction. And it'll be difficult for mortgage providers to know how to reflect this on the basis that this is being done as a reaction to the coronavirus, and that by virtue of that, it's meant to be a short-term decision. So it'll be interesting to see if that does get reflected into borrowing rates or how much of that passes on. The downside of those holding cash, and so if you're in a sort of a cash-heavy position, no doubt it's going to prompt conversations around, is that still a good strategic and long-term position to hold? But certainly it makes it less and less viable to keep a large quantity of cash over the long term, given that inflation is running at higher than interest rates.
Thank you. I suppose to summarise, it's a good time to look at your investments, your financial planning, but with a long-term lens. Thank you very much for your time today, Sam, and for joining us on the Street Sessions.
No problem at all.